Okay, good afternoon. Can you hear me?
Yes, sir.
Can someone respond? Can you hear me?
Yes, sir.
Okay, thank you. Now, let's start with a new session today. Up to last week, I think you might remember we discussed financial institutions. Basically, we looked at different types of financial institutions and what is their role in the economy and how they basically support the financial services in the industry, in the market, and what are their assets and liabilities. These things we have covered in detail. And in the exam paper, there is a separate question, one particular separate question related to financial institutions, right? Now, I hope you had a chance to look at the past papers and you basically attempt to answer these questions uh, as much as possible. And we will find some time, as I said, uh, as the time passes in the upcoming sessions to discuss some of the things related to these questions, things in the sense we might try to cover some of the uh, questions, then you will have some idea how to basically answer. But even without that, you can simply basically look at the past papers, marking scheme, and you will get a get some sort of an idea how to basically approach these questions and how to answer these questions in the exam paper. So that is my request. As I always tell you, basically you have to look at the financial press. That is one of my continuous requests. uh, you have to basically look at uh, the 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 financial press, and you have to also look at the past papers uh, based on the materials we discuss, right? uh, so today we are moving to a new area, as I said. That's basically financial instruments, because instruments and actually markets we discuss together, because these instruments are traded in the markets by financial institutions, and probably the different players in the financial sector, they use these instruments. So today we are basically discussing the markets and products, because the financial activities or the services in the system happens through these products and markets. So to start with, let's define the financial market. Now, financial market is basically defined as a place where that individuals and institutions meet together to trade financial assets. Now, when I say a place, it doesn't mean it has to be a physical uh, place, or you have to meet in person. The place means the your interaction, basically, whether it is physically, virtually, electronically, doesn't matter. You meet individuals and institutions, and trade financial assets. So in the financial markets, you basically trade financial assets. Now, when one particular party is basically creating an asset, that can be a liability to the other party. That's the nature. If I'm basically, let's say, having a deposit, as a deposit holder, I am a asset holder, right? But if I deposit that money with a bank, and the bank becomes the liability, he has the liability of paying back my deposit. So likewise, if you create any asset, there is a corresponding liability as well that we have seen from the last week's discussion, the bank balance sheet. And also, if you remember, there are no corresponding assets or liabilities if it is an off-balance sheet activity, which means a kind of a contingency or a commitment, some contra item. It is not recorded on the balance sheet. So in that case, only you don't have a corresponding asset or a liability, but otherwise, whenever you trade financial assets in the market, you basically create assets and liabilities in the balance sheets. Now, when you meet in the financial market and do trading or exchange financial assets, how do you do it? Basically, in the form of instruments, or you can call it securities, or some people call it financial products. So these instruments, securities, products, whatever the name you use, that is the mode to trade in the financial market in channeling funds from lenders to savers, or lenders means savers, or to borrow and to borrowers, from lenders to the borrowers, or you can call it savers to the spenders in the market. And for that purpose, there are various instruments are traded in the market. If you take the financial market as the universe, in that universe there are various layers, as we already know, in terms of institutions, and at the same time there are various instruments or the products traded in the market. So in this session, what we will do, we will look at these various instruments which are traded in the financial markets. Now, what is the function of financial markets? Basically, they help us in a couple of important things. One thing, the financial markets are helping to, gauge price information about financial assets. Now, we know in the markets, the trading is happening through price mechanism, not only in financial market, in any other market. The trading is happening through price information. So the price information and price discovery process is really important. To do a price discovery means what, basically to make sure that the transaction happens through a particular price, decided price. For that matter, you have to have information on prices. So the financial markets are basically generating, exchanging, providing this price information about financial assets. For example, if you go to a bond market, in the bond market, you have information on bond prices. In the securities exchange, stock market, you have prices of stocks. So these information are available and provided by the financial market. That's one thing. Second, financial markets are offering the liquidity for assets. Liquidity for assets means offering the tradability or marketability for financial assets. Because as we already seen, financial market helps in exchanging financial assets. So whenever you exchange, some people you basically whenever they buy a financial asset, some people have two options. One, people might keep it, or in finance terms you call it held or hold until the maturity. So in institutions there is a portfolio called held to maturity. That part is not traded. And some people, they would like to trade financial assets. You buy today, in a moment you might sell it, or maybe days after you might sell it. So that is basically tradability, trading. In some balance sheets you might see the trading portfolio, which means that part is for trading activity. So assets are basically held for maturity or traded, or you keep it until maturity, or you do trading, active trading. So for active trading, you have to have the liquidity or marketability in the financial markets assets. So that is basically supported by the financial markets. And of course, the financial markets are helping us to reduce the buying and selling cost of the financial assets. Now we understand the financial market is basically providing direct finance. Remember, direct finance, which means you are meeting, in the most of the cases in the financial markets, are people meeting directly to trade financial assets. Other than these deposits and some of the assets, most of the financial market assets are basically traded directly in the market. Let's say bonds, let's say securities, debentures, these are basically traded directly in the markets. So when you do this transaction, that helps us to reduce certain costs. One of the costs we already know, search costs, expenditure of time and resources associated with finding a suitable trading partner. That is one thing. You have to search who's your basically trading partner. Information cost. So whenever you buy a financial asset, you have to assess relative merits and or pros and cons of the financial assets. So that assessment involves some information cost. So the search and information costs are reduced in the financial markets. Overall, that promotes efficiency or economic efficiency in the broader economy, because it helps us for efficient allocation of resources, basically capital. So capital, this is financial capital. So the financial capital is allocated uh, efficiently. Resources are allocated efficiently through various activities or towards various activities, which at the end of the day, which will help in increasing the production, which means producing goods and services. So ultimately, whatever we do, that facilitates the real economy. So the financial markets are helping the real economy for the efficient resource allocation. Now, when I say efficient resource allocation, another thing comes to our mind, that is financial market efficiency. This is actually some theoretical discussion, this part, right? It's not actually some practical or what we observe in the markets. What I discuss right now is something like uh, basically the uh, some theoretical conceptual thing I'm discussing right now. These are actually, sometimes in your paper you might see some relation uh, uh, some what do you call some relation uh, with the discussions we have in terms of the actual performance in the market. But basically what we are uh, talking here is some conceptual background. uh, Let me talk about financial market efficiency as a theoretical background. Now, the efficient market hypothesis, we are talking here, the efficient market hypothesis that is related to market efficiency. Now, this was suggested by a person called Eugene Farmer. Eugene Farmer is an economist, American economist, who suggested this theory in 1970 or 71. For his contribution, I think he received the Nobel Prize in 2000. I'm not so sure the year, but after 2010 or so. So what he suggested is, if you take the financial markets, and in that financial markets you trade financial assets or the securities, and in those securities, whenever you trade, information is really important. Based on the information you do trading, and his argument is this information content is really important for effective or efficient trading, and the prices in the market would reflect the information content. In other words, he said, when the market is efficient, the prices of a security will reflect all available information. Prices will always fully reflect available information when the market is fully efficient. Now, that is actually some, as I said, theoretical, some optimal situation. So, perfect situation. Now, in real world, you don't observe that perfect world or perfect situation. Or in real world, you might not observe full efficiency. But it is really important, even though it is a theoretical concept, in order to understand the dynamics and the conditions of the market, and also whenever you do trading, this hypothesis is really important. So this hypothesis, as Pharma suggested, you call it efficient market hypothesis or EMH in finance. If you have studied finance, that is really an important area and also very active research area in finance, efficient market hypothesis. So in short, you call it EMH, where you suggest prices always fully reflect available information. Now, what is the significance of this understanding or the efficient market hypothesis? So according to this theory, when the market is efficient, or which means when the prices are reflecting available information, you cannot basically beat the market, which means you cannot go against the market and do trading or make profits out of that. Now, in economics, we always talk about profits, and that profit is basically taken as a normal profit. Normal profit means something like long-term stable profits, and there are some conditions called abnormal profits as well. So abnormal profits means, or you call it supernormal profits, which means what you earn than the actual earning that you have to earn, or it would be the earning that would exceed your natural or normal level. There are some situations like that. You have temporary boost in prices that would create an extra profit which is above the long-term average profit. So in finance also, you can make abnormal profits, abnormal returns. For example, in the stock market, if in a particular day prices are going up, you sell it, you sell the security, and you can make some extra profit which might be above the long-term average level, but that is temporary. Now, according to efficient market hypothesis, when the market is efficient, investors or the participants in the market, they cannot outperform the market because all available information is already included in the security price. So a bond price or stock price which is determined in the market is based on available information. There's no information is left. If some information is left, or it's not included in the price, that would create some profiting of opportunities, right? That's how people make profits in the abnormal profits in the financial markets. If you have information something else other than what others have, or if you have extra information, if you have some additional information compared to the others, that might lead to make abnormal returns. But then again, it's not long term, right? Even that information becomes normal or available, then you cannot beat the market. So that is the real important thing. So when the market is efficient, we think no one cannot beat the market and no abnormal returns. The market are actually making normal profits. Now, theoretically, I think you have some idea what is meant by efficiency. That is basically relating to information. Information is reflected in the prices. Now, based on that, here I have put up some kind of a graphic here. There are different forms of efficiency, which is not very relevant to our discussion, but for your understanding, I have just included this thinking that what type of information we are talking here, right? So in that sense, the efficient market hypothesis suggests three types of efficiencies. One is weak form. So in the middle, we have weak form, which means the prices are reflecting all historical prices and returns. So if someone is trading, or if someone is acting in a market where the prices are based on historical data, historical information, that market we can call it as a weak form market. If you have this historical information plus some other all public information, let's say, what do you mean by public information? Information available in public domain. Annual reports, rating reports, investor prospectus, any other special reports, data, web-based data, cash flow information. If it is available to the public, that is simply you call it as semi-strong market. So in the semi-strong market, you have all public information, which means historical prices and what is available in the market. Third form, which I mentioned as the optimal level, that is actually a kind of a hypothetical situation. You may not have that in the market in real scenario. In most of the cases, you are trading in the semi-strong market, right? But you can talk about a strong market where prices reflect all information, public and private. So if a particular price reflects all available information, that means that market is fully efficient or strong efficiency. Now, what are these private and public information? Public information, as I already mentioned, what is available. Private information means there are some information only available within the firm, within the company. Even that is available only for directors, not even for employees. So those information you call them as inside information. Inside information. So inside information is not available for outsiders. But if by any chance a market is, happen to have those internal information also, the price could reflect that information as well. So some people do trading based on this internal information. Probably you may have heard the word insider trading. Insider trading. I'll type it here for your benefit. Insider trading. So insider trading means you are basically using all information, private and public. So private information is really difficult to get, but you strategically try to get it. Some people, maybe you are having internal relationships with the people internally working. Maybe you are, basically bribing to get information likewise. So all these things can happen to get basically internal information. So as a result, in some countries, this insider trading is prohibited, illegal, because it is against the market practices that you are trying to get, other company information illegally. But if that information is available, as I said, if you are trading based on that, your prices would be fully reflective of all information. In other words, the market becomes strong form efficiency. Right? I just wanted to tell you here, in our paper, we are not, questioning on efficient market hypothesis, but we are really talking or concerned about the validity or importance of information in the market, because information decides the prices. I'll give you an example. Now, in a particular day, the stock market would reflect based on information. Let's say on a particular day, you are trading a particular stock. Let's say you are trading some hotel stock, right? Now, the stock is trading, in a usual way. But if additional information comes to the market saying, okay, that particular stock is going to declare a dividend tomorrow, for example, then that is some new information to the market. So what will happen? The stock price would reflect. The stock price would respond. The prices would start going up, because that is, affecting the price behavior, this new information. Same with the bond market. If there is a political news, sometimes you might see stock market is some days political is down, some days it's positive, or it's going up. So these are very responsive or sensitive for information. That is the message. Now, let's also look at the financial risk. I think risk we uh, generally discussed last week, and then we looked at what are the risks faced by particular financial institutions. So here it is, here what we have is the same thing, but we look at from the market perspective. Now, risk, we already know it is the exposure to danger, or the possibility of making losses. In other words, uncertainty of returns or making financial losses. Now, the financial risk in broader term is a term that we use to understand multiple types of risk. We already know these risks, but here, if you take some of the risk in combination, you can call it financial risk, or which will arise from several various risks. So these risks, I hope you remember, we covered these risks basically in our previous session. But here I am putting three risks into your attention: market risk, credit risk, and liquidity risk. So those three risks are elements of financial risk. So financial risk can be arise or can be occurred due to all three or one of these risks. What are these risks? The market risk. Market risk means we already know the possibility of falling value of the asset due to price changes. Here basically two things I have mentioned: exchange risk, interest rate risk. Remember, if interest rates are going up and down, that would change the value of the asset. If the exchange rate is fluctuating, that will change the value of the asset. Remember, I also mentioned to you the asset price risk, stock price, for example. That is also part of market risk. That would also create risk to the value of the asset. So the financial risk is arising due to market risk. Credit risk, we already know, possibility of the borrower not paying the lender uh, his capital or the interest, could be both. So if someone is basically defaulting, that creates credit risk, uh, which we have already covered. So it could lead to some insolvency. So insolvency means the company might go bankrupt with the non-receiving of their debt. So let's say a bank gives loans, and borrowers, they borrow and they don't pay. Let's assume majority do not pay. So what will happen? The bank is facing an insolvency risk. They cannot continue. Solvency means basically continuing. So insolvency means you have to basically declare that you can't run the business. That is the idea. So credit risk could lead to insolvency, and that is part of financial risk. Liquid risk, I already discussed last week, the possibility of not being able to buy or sell assets due to certain reasons. Probably you don't have enough buyers and sellers, or maybe when you are trying to do so, that could create enormous losses. If you are trying to sell it very quickly, that could lead to reduction in value, market value, leading to losses. Likewise, there could be a risk arising due to tradability aspect. Liquidity means here tradability. So all these are part of the financial risk. And risk is inherent. Remember, I told you sometimes back, we never know where the risk is, and also we cannot avoid the risk fully. The risk is there. So amidst the risk, which means even if you are facing risk, you don't give up, right? You basically do financial transactions because if you take or if you bear certain risk, you might be able to earn a certain amount of return. So risk is basically associated with return. And also that association is simply a positive association. What do you mean by positive association? Whenever you have higher risk, that could generate higher returns. So in other words, if you observe, if you are earning high returns, that is basically associated with higher risk. So in simple terms, greater the risk, larger the return. Why is that? Why do you need to have higher returns when you have high risk? So you have to be compensated for bearing high risk. Otherwise, you don't have any incentive. Why do you bear high risk instrument? because you are compensated more. That is the incentive. So if there is no incentive by way of returns, higher returns for a high risk, you will not take such risk. You will only take the risk if there is a adequate or acceptable return for you. So there is a clear relationship between risk and return, and you call it risk return trade-off, which means whenever you see high risk, that is simply creating high return. So the trade-off is what level of risk and return you have to choose, right? So whether you are choosing high risk, high return, a certain end, or the other end, low risk, low return, which trade-off? So which combination? That is one of the questions faced by financial market players. So which type of assets that you should trade, which amount of risk and return that you have to earn. That is a kind of a very common question in finance. So if you look at this information in the charts, right, there are various instruments in the market. As I said, these instruments are having different levels of risk. Now in the first chart, actually what we have is on this axis, the vertical axis, we have annual return in average terms, so which means the profit, right? On the other scale, you have simply uh, the standard deviation. Standard deviation is used to measure risk, right? Measure risk. The annual return is used to measure the profit. There is a slight difference between profit and return, but simply the idea is what you earn from your asset, right? So if you look at this chart, the red line, you will see that is simply a positive line. Why it is positive? If you plot the return of certain assets and the risk of certain assets, you will see whenever you increase the return that of an asset, that asset will have higher risk as well. Now, for example, here we have T bills. T bills means treasury bills. T bonds, treasury bonds. Both are having relatively low risk. So on this axis, risk is less than 10% standard deviation. But if you look at their return is also low. It's up to 6%. If you take some other assets like large company assets, small company assets, their risk is high, but at the same time, returns are high. These assets, they are normally bearing, more than 20%, 25% risk, but still they earn more than 15%, 20% return. So in the private sector, the stocks or the company instruments will generate high returns, but at the same time, there is high risk. The government instruments will generate lower returns, but of course, they have low risk as well. Why? The governments are generally considered as, sovereign institutions. So sovereign institutions is a general understanding. They don't default, right? We never think that the government would default. There could be a delay of payments, but generally they are not simply defaulting. So as a result, you have low risk of default and still you have low return as well. So investment risk pyramid is also very similar idea. So in the pyramid, usually you have higher risky assets in the top of the pyramid. Low risky assets are on the base, in the base of the pyramid. So for example here, stocks are having the highest risk because that is subject to lot of risk, especially market risk, right? When prices are changing, stock prices are changing, so they have the highest risk. Deposits are having the lowest risk because banks are usually they are not defaulting of paying back. Even the bonds are having lower risk because the governments are not uh, defaulting. So here also we have the same thing. I can't I made it expanded for you to see it very clearly. Now here in this pyramid on the top, you have assets like stocks, junk bonds. Junk bond means low rating bonds. Options and future contracts means derivatives. They are having a speculative behavior. Speculative behavior means high risk nature. People are investing in these assets thinking that the prices would go up, go down very sharply. So thinking that part, you do some investment. So there is some category of investors, they would do these kind of trade. On the base, you have something like very safer instruments, savings account, CDs, treasury securities, insurance, money market accounts, even the cash, they have a lower risk. That's why you have it in the base of the pyramid. So in between, you might have other companies. Blue chip stocks means basically good companies. uh, Trusts and real estate, they are basically having a little relatively lower risk compared to the speculative asset. So this investment pyramid is giving an idea for us about the level of risk of particular instruments that we observe in the financial markets, right? Now, one of the key questions in finance, if there is uh, any kind of a risk, how do you basically uh, reduce such risk? Now, risk can be reduced by various modes. Now, the first question is whether you can reduce the risk, right? Now, you can reduce the risk. There is a possibility, but there's a limit also that we have to understand. So, the financial risk that we talked earlier can be reduced, or at least you can reduce partially, not fully, through a process called diversification. So through diversification, you can reduce the risk. What do you mean by diversification? Diversification means you are forming a portfolio. Portfolio means, in simple terms, portfolio means you have different assets and instruments in your investment investments. So if you take the bunch of your investments, there are various assets and asset classes, types of assets and the classes. So in that way, you can eliminate the risk of individual uh, items or individual assets that you have. Now, let's say, for example, you have a portfolio, right? Portfolio means what your investment stock investment bunch. So in your portfolio, let's say you have only one stock. Let's say you have hotel stock. You have bought a stock of a hotel, and that stock is in your portfolio. Let's say you have 1,000 stocks in hotel A. Now this is only one asset, no diversification. Now what do you think about the risk level? Do you face a higher risk or a lower risk? If you have only one asset in your portfolio, what do you think? I need an answer. So in your portfolio, you have one hotel risk portfolio. Sorry, hotel stock. How about your risk? Is it high or low? I'm asking series of questions now. Can someone give me an answer? Where are our, people? Are they here? Yes, you can see familiar names. They are all here. What do you think? I'm telling you again. Let's say in your portfolio, you have bought one particular stock, 1,000 shares of Hotel A. In your portfolio, you only have that share. I'm asking, are you facing low risk or high risk? High risk. Dilshani, yes. Why it is high? My next question. Why it is high? What could be the reason? If it is a stock, give me an example why it is risky. Probably you have the answer. You might be, basically thinking of how to put it. I'll give you the answer. Now, let's say you have one hotel stock and the hotel sector is not doing well. The best example is now, right? Right now, the worst hit sector in the economy is the leisure sector, hotel sector. A single hotel does not have a foreigner, right? So all the stock hotels are basically running at a loss. Even they are not, at break-even point. Break-even means no profit, no loss situation. Even they are below break-even, which means most of them are making losses. So in the period like this, where you make losses, what will happen in your portfolio? Your portfolio will also make losses. Why? There is a practice called mark to market in finance. So if your portfolio is mark to market, what will happen? Which means your stocks are valuing based on the current prices. You will see you are making losses. Why? You have bought these stocks at a particular price. Let's say you bought at 100. Now the current stock price in the market is 75 because the hotel sector is not doing well, prices gone down, no demand for stocks. So now you are making a 25 loss from each stock. So that is mark to market loss. Why you are making losses? Because you are only having one stock in your portfolio. Let's imagine another situation. Let's say in your portfolio you have two stocks. One hotel, the other one is, let's say, a manufacturing company. These days, let's say you have a manufacturing company manufacturing mask, right? So this is a good period for manufacturing. Let's say for the mask manufacturing, it's a good period. Earlier, what you used to buy at 5 rupees a mask, now let's say 45 rupees, making 40 rupees profit. So stocks related to that company would be going up. So you are making losses from hotels, but you are making profits from the manufacturing. So in that case, your portfolio will not have a loss because it is a combination of assets. Similarly, you can have some more assets. If one sector is hit, the other sectors are doing well, then you don't have a problem. So that happens through diversification. So in this chart, I have put a chart to indicate diversification. So at this point, here we have number of shares, here we have the standard deviation, which means the risk. So if you take this point, only one stock, one share, what is your standard deviation? It's actually 1, which means 100% risk. You expand your stocks like 6, 11, 16, likewise, then what will happen? Your risk is coming down. You can see from this chart, it's a negatively sloping curve. So the risk is coming down. So the idea is whenever you diversify, which means you increase your assets in the portfolio, you bring down the risk, right? So how do you diversify? Based on various assets? Here I have put again a drawing image. Might be you can diversify across various instruments like real assets, cash, gold, stocks, government securities, mutual funds, etc., etc. You can have different types of assets in your portfolio. I presume you have the term, this common saying, don't put all eggs into one basket, right? If you have 10 eggs, don't put eggs into one basket. If the basket is fallen, all eggs will be broken. So if you have 10 eggs, put it into basically at least 2 baskets, 5. If one is broken, still you got 5. So your loss is minimized. So that is meant by diversification, expanding your assets across various instruments and sectors. So risk can be reduced through diversification. Now there's one more observation in this chart. If you look at the tail end of this chart, this part, you will see even though you diversify, which means you increase assets, still your risk does not become to 0 level, right? So here still you have some risk. Can you see in this chart where I have put this arrow? Here still you have some risk because it doesn't come to 0. Why it is not coming to 0? Through diversification, that's true, you are reducing risk, but still you cannot avoid certain amount of risk in the market. That part of risk, you call it non-diversifiable risk, or in finance you call it systemic risk. Systemic risk measured by beta. Beta means it's like a calculation, beta calculation, right? So systemic risk, even though you diversify, you cannot avoid systemic risk because that risk will be there anyway. Why? That is basically the countrywide, economy-wide risk. You might be having price changes in the economy, inflation, other issues. Broadly, there is a broader market risk that you cannot avoid. That's why you have this risk. So the message is, through diversification you can reduce risk, but you cannot eliminate it fully. Still you will face some risk even if you diversify. That undiversifiable part is basically due to system-wide factors that is simply arising due to economic related issues. So that is one way of reducing risk. And sometimes we also talk about another method of reducing risk, hedging, right? Hedging is applicable to have a protection against the market risk. Right? So in the market, we know prices are going up and down. Prices are going up and down. Those price movements are leading to what? Market risk. So that adverse price movement in an asset could lead to losses. So we can have a protection against that price movements. So that's what you call as the hedging. So through hedging, you are trying to have a protection against price changes. How do you do it? You use an instrument called derivatives. Derivatives. So derivatives are, we will be covering derivatives in this discussion in the latter part. Derivatives are used to mitigate the market risk arising due to uh, price changes. Now you can hedge against many type of instruments like commodities, securities, currencies, interest rate, right? Even weather, you can have a hedging against this. So what type of hedging you can have? Basically, you can have forward hedging, futures, likewise, these are instruments, right? So I will discuss those in detail when we come to derivatives, but at this point, you might simply keep in mind that through hedging, through having a protection against price changes, you can reduce risk to certain extent. But hedging is a kind of a risky instrument, or risky means some kind of a uh, sometimes it's unpredictable. It depends on the the price movement. Sometimes the hedging can be used, can be beneficial for the party. Sometimes it could generate more losses. There is such possibility as well. But people would like to have hedge because that creates some uh, space or some protection for investors against price movements or the price changes, right? Let's come back to them later on, but now let's move to the different types of market conditions, so definitions. So in this part, we group financial markets into various sub markets by looking at their characteristics. Now, if you look at the financial market as a whole, we observe there are various sub markets. We might have stock markets, bond markets, commodity markets, money markets, derivatives, futures, insurance. Likewise, there could be various markets, and these markets can be divided into various subgroups depending on their characteristics or the features. Now here we basically look at four important features of the financial instrument. What are these features? We first look at the nature. Claim means the asset, right? So what is the nature of this asset or the the liability, whatever, the cash flow, right? What is the nature? What is the maturity period? How long will it take to mature? When it will be delivered, whether it is today, tomorrow, or future, the time of delivery. When the organizational structure in the market, which type of organization is used to do this transaction. So based on those four characteristics, we can divide all these markets into few areas, right? So based on the nature of the claim, we can divide markets into debt market and equity market. I'll discuss them in detail. Maturity period, when it is maturing, based on that, we can identify money market and the capital market. Money market and the capital market. This capital market we can divide again as the primary market to secondary market, right? Primary and secondary capital market. Even the equity market you can divide into primary market and secondary market. I'll show you why. So that is for the maturity period. Timing of the delivery, which means when the transaction is delivered happening. So based on that, you can call it a cash market or a future market. Cash or future. And the structure in the market, whether it is based on an exchange or whether it is over the counter. Exchange or over the counter. So those are the features that we look at in the market in terms of identifying different segments in the market. So in the next part, I'll be discussing these different markets to give you some understanding, and I will also take some of the other markets at the end, right? Not only these, here we have something like 8 types. No, there are few other types also. I will take them at the end of this part. So first we look at the primary and secondary nature of the market, right? What do you mean by primary and secondary? So in the primary market, you do new issuances or you issue securities for the first time. Why? Why do you issue securities for the first time? To raise new funds. If you want to raise fresh money, collect new money, how do you do it? You do a security issuance. For example, you do a sale of new stocks, new shares, or you do a new bond issuance. So sale of new stocks, what do you call it the first time? Can somebody suggest the name? If you are issuing stocks for the first time, what do you call it? You can call it primary issuance of stocks, but there is a particular term for that. Who knows? IPO, initial public offering. Iman is correct. You call it initial public offering or IPO. That is the primary market of the stocks. In the bond market, primary issuance is simply issuing bonds to the, in Sri Lanka, primary dealers. They are the primary market active players. In some countries, there could be other players, but issuing bonds for the first time, they are not in the market. So that you call as the primary market. So I told you, so whenever you buy these new instruments, you have 2 options. Either you can keep it until the maturity, which means held for maturity, or you can do active trading, which means you can have a trading part also. So if you are trading the instruments, what you have bought from the primary market, you come to the secondary market. So in the secondary market, securities are traded among investors what they have already purchased or issued. In that way, you are simply doing buying and selling securities in the secondary market. So as a result, what you will do, you alter your portfolio. In your portfolio, let's say you have earlier 100 stocks, what you have bought from the primary market. Now in the secondary market, you are disposing 50. Disposing means you are selling 50 stocks in your from your portfolio. Now as a result, from 100 to your portfolio came down to 50. So you alter your portfolio through the secondary market. You can buy something else. You sell one particular stocks and you might buy another stocks or other bonds. Likewise, the portfolio, the total collection of assets can be changed through the secondary market. Having a secondary market, active secondary market is considered as an important element of market development. Now, if people just buy instruments and if they are just keeping it, there's no active market, right? To have an active market, people should come and do activities, which means they should buy and sell securities. So this buying and selling is happening in the secondary market. So for the bonds, secondary market in Sri Lanka is primary dealers they purchase or buy bonds from the primary market, from the central bank, and they sell back those bonds into investors in the secondary market. That's how the bond market works, even the bill market. In the stock market, how it happens? You issue or you purchase stocks from the IPO, primary issuance, and then you come and sell them in the secondary market. Where is the secondary market of the stocks? Where do you have the secondary market for the stocks, shares? Can anyone answer? For bonds, you have the secondary market, bond market, or some people call it secondaries market. For equities, shares, where is the secondary market? Where do you do this trading? Stock exchange, correct. You can call it stock exchange. Here in Sri Lanka, that is through the Colombo Stock Exchange. So the stock exchange will help the buyers and sellers of the stocks to come and do trading, active trading, to buy and sell assets or the stocks. That is the secondary market. Okay. So now let's look at the nature of the claim. Nature of the claim. Nature of the claim means what is the basic feature of this asset. Based on that, we can divide markets into debt and equity market. Debt and equity market. First, let's look at the debt market. So in the debt market, the financial market participants are issuing debt or buying or selling debt, which means you have a primary debt market or secondary debt market. So debt market is simply referred to as the bond market, or some people call it credit market. Why? In the debt market, you have bonds or loans actually in the debt market. So loans are also a kind of a debt instrument. A bond is also a kind of a debt instrument, right? So what is the key feature of the debt market? It's a contractual agreement between the borrower and the lender. So what is the contractual agreement you have? That you are promising that the holder of the instrument will receive a fixed amount of money or cash flow at regular intervals until maturities with the interest and principal. Let's say you are trading a bond in this debt market. So if you are the bond holder, the issuer of the bond will pay you until the maturity of the bond. You will get some coupon with interest, or maybe at the maturity you get maturity value. There are zero coupon bonds as well. For example, treasury bills, they are zero coupon. If it is the loan market, how it works? What is the contract? You enter into contract to pay in regular intervals, the loan and the installment. The installment carries both the principal and the interest. So that is also a contractual agreement. So bonds you can divide into various aspects: treasury bonds, corporate bonds, mortgage-backed bonds, money market bonds. Likewise, the time could be short term, medium term, long term. Likewise, depending on the time period also, you can have various types of bonds. So here I have simply put a picture for you to get some understanding about debt instruments. So debt instruments you can broadly divide into long term and short term. Long term are basically bonds and debentures. Short term are basically money market instruments, which means, simply you can call it short term loans even. So here you have under various long term and medium instruments, you have various instruments. So these instruments we will be discussing later. So these are the instruments of debt. In the equity market is an aggregation of buyers and sellers of stocks. You call them as shares. So as a result, you call it the share market, the stock market, or equity market. There are various names for this market. Stocks or shares are, how do you define? Claims to share in the net income and the assets of the business. So a stock is a kind of an assurance, a certificate that you have the right to ask or right to claim the net income and assets of the business. Net income means profit. You have the right to ask for the profit or the assets, both. So stockholder is having such ability. So these include securities listed on the stock exchange, you already know. Stocks are paying some periodic payments, dividends. Periodic payments means dividends. And these are considered as long-term securities. So in the equity market, there is no maturity. So by name, by default, an equity market is a long-term market because there's no maturity, and as a result you call it capital market, right? Equity market is part of the capital market. And in general, an equity holder is considered as a residual claimant. Residual claimant means in the case of a bankruptcy, the equity holder will get his dues as the last recipient, right? So in the case of a bankruptcy, debt holders get priority because it's a liability to the company. So the liabilities are first settled. So when you settle liabilities, the debt holders get the priority. Equity holders are basically owners. So owners, they share the risk, they share the loss, which means they become residual claimants, right? So equity market, the stock market, you can divide into secondary market, primary market, as we already know. Secondary market is the stock exchange. Primary market is the IPO. We already know it, right? Then by considering the time to maturity of, or the maturing time of the instrument, you can simply divide the market into two aspects: the capital market and the money market. So capital market, simply the long-term market where you have instruments with maturities greater than 1 year. So in the capital market, always you have instruments with a period of more than 1 year maturity. So whenever you buy a capital market instrument, that will have a longer maturity. As I said, stocks do not have a maturity time. So as a result, they are considered as long-term instruments. What is the purpose of having the capital market? The key instrument or the purpose of the capital market is to facilitate raising long-term funds, because you don't need to pay or settle in a shorter period. You can raise for money for a longer period. So whenever you have money for a longer period, that can be used for capital purposes. Capital purposes means to accumulate the stocks, resources in the economy. The physical resources of the stocks of the economy can be enhanced using long-term funds. For example, a company can build a machinery, or they can buy a machinery, or they can build a plant using long-term money. So capital market provides long-term money. There are various instruments like bonds, treasury bonds, private debt securities, which means debentures, equities. I mentioned to you, they are considered as long-term instruments, capital instruments. There are key issuers, the government, banks, corporate, etc. So here I have put a very clear diagram. Financial market, if you divide into two, the capital market is simply having two markets, the stock market and the bond market. Stock market, essentially there's no maturity. Bond market, maturity is there, but more than 1 year, right? If the maturity here is only up to 1 year, that is not considered as capital. That is simply the bill market, right? In Sri Lanka, the bill market is having 1 year maturity. So more than 1 year you consider as the bond market. Then the money market. Money market is simply instruments with maturity of less than 1 year. So they are maturing in maximum of 1 year's time. The basic example is a treasury bill. A treasury bill is a money market instrument. Why? There are different maturities like 3 months, 6 months, but maximum 1 year. In 1 year's time, it will mature. There are some other instruments considered as like repurchase agreements, repo, commercial papers. They are also considered as short-term money market instruments. Why? They have a shorter tenor. Maximum is 1 year. Why this is important? To raise short-term money. That is the purpose, right? So if you need money for short-term, you can rely on money markets. So governments are relying on short-term money, which means by issuing bills. Every week they are issuing bills. Why? That is short-term money for short-term purposes, for paying salaries, etc., etc. For long-term purposes, they can use treasury bonds, but for short-term purposes, they use bills. There are two important features of this market. One is the money market is having high liquidity. Why? These instruments are considered as very close to money. So their moneyness, liquidity is very high. Treasury bills are considered as highly liquid instruments. Why? You can convert it to money very easily, quickly. So money markets are very liquid. They are considered as low default risky market. So the risk in money market is very low because it's only short term, and most trustworthy participants are participating in this segment. For example, the government and the banks, they are generally considered as very trustworthy market players. So in that case, they are considered to have low default risk, and usually transactions are happening in large scale because mostly banks are the and the government are the participants of this market, right? Then we have another classification, the time of delivery. Time of delivery, when the transaction is completed, that is the idea. Whether the transaction is immediately done. Let's say you buy a security. Whenever you buy the security, you pay cash. You buy the security. When it happens, whether it is happening immediately or later, that will decide the timing of the delivery. Right? So as a result, we can divide that market into two aspects: the cash market, sometimes you call it spot market, and the future market, or sometimes you call it the derivative market. So in the cash market, spot market, the financial instruments are traded for immediate delivery. Immediate delivery. So you do the transaction today and you have to complete it immediately, delivery immediately. So whenever you say delivery immediately, it doesn't mean today itself. It takes up to 2 working days. So the spot market or the cash market is sometimes you call it as T+2 market. Okay? Sometimes whenever you say cash, for example, in the foreign exchange market, cash transaction means settlement is today, right? But in the spot market, the transaction is T+2. But both are considered as immediate delivery without much delay, maximum 2 days. In maximum 2 days time, the transaction will be completed, which means, let's say you buy currency. So your currency value date will be 2 days time. That is the max. So this is a kind of can be an organized market, exchange, or over the counter market, anything. I'll explain that part later. Derivative market means you don't deliver it today. The transaction is taken place today, but the delivery, actual fund movement happens in future. For example, a future contract, a derivative. You enter into the transaction today, but the actual trading date could be in 1 month's time, 3 months' time, 6 months' time. Why do you have to have this derivative market? Spot market, obvious, you have to fulfill your immediate cash needs. Why you need to have a derivative market or a future market? Because to manage your risk, right? I told you, through hedging, you can reduce risk. So this is similar to that. You can manage risk through the future markets. Future prices you can agree today. So you do the transaction in future based on the agreed price today. So that is simply the future market. So that is one classification, time of delivery. And then finally means the different types of markets. You can look at the structure of the market, whether it is an auction based or something else. Some markets are very competitive, and based on the competition, you do buying and selling. So people enter competitive bids to buy, competitive bids for sale in the competitive markets. Let's say in the bond market or the stock market, people are basically trying to buy or sell goods through bids and offers. So the price in this auction market is reflecting the highest price that the buyer is willing to pay and the lowest price that the seller is willing to sell. So the price mechanism works in the auction markets. The auction is basically simply based on price. So the benchmark for the auction is simply the price. The guidance for the auction is simply the price. So bid prices and offer price. Bid price means what you buy, offer price means what you sell. So based on the interactions of bids and offer prices, price would be determined, and that is simply happening in the auction market. So where does the auction happens? It is happening at a central location, which means the exchange, stock exchange, right? So buyers and sellers of securities are meeting in a stock or a whatever the bond or exchange to conduct trading. Okay, so that is one structure of the market. So the main feature is in the auction market, simply the price mechanism works as a guidance. Then we have the OTC market. OTC means over the counter market. This is simply a decentralized market without a central location. Now in the stock market, you have a central location. May not be a physical place, but it's a central location. All the transaction happen centrally. OTC market, it is a decentralized market, which means you do not have a central or physical location. Market participants are meeting through various communication modes, through telephone, through internet. They quote prices through telephone and internet and buy and sell securities or currencies in this market. So basically dealers are supporting this market, and such trading is not listed in the organized exchanges. Best example for the over-the-counter market is the foreign exchange market. So the foreign exchange market, if you look at it, it is not an exchange. It happens through dealers. So dealers are buying and selling foreign exchange in this market through various communication platforms. So they are connecting with different parties through email or through any other mode. No central location. So you can do transaction with different parties over the counter using different communication modes. So up to now, what I have done, these 4 features I have covered, right? Those are the key features. Now let's say if you have a question, what are the key features that you should consider when grouping the financial markets? These are the main 4. The nature, maturity, timing, organizational structure. So based on that, you can see whether it is a debt market or equity market, money or money capital market, cash or future market, exchange or over-the-counter market. So up to now, we have covered that. And depending on the transaction also, you can classify market into 2 broad areas, the retail market and the wholesale market. Retail market means providing financial services for day-to-day activities, day-to-day banking, credit facilities for individuals, families, small businesses. Likewise, wholesale market means available money or transaction to deal in large quantities, right? So wholesale market is simply happening within the banks actually. Interbank market is the main wholesale market. For example, a bank is buying and selling securities, so by borrowing or lending money with another bank. So that is not in small quantity, not in millions, right? Or in thousands. Usually it's in billions. So bank to bank transactions are generally in billions. So that is simply the wholesale market. Then we look at an important market, the foreign exchange market. So this is one of the important markets, and with that we are entering into the discussion of foreign exchange rate. Okay, let's look at the now. Mind you, this is a very important part starting from here. That doesn't mean what we have discussed not important, that is relevant, but this is really important because there are some questions in terms of calculations and some conceptual related questions are uh, uh, coming from this foreign exchange market, right? So the foreign exchange market, simply you call it forex market, FX market, some people call it FX market. In the banks they use the word forex or FX market, or some people call it the currency market. Whatever you are dealing in foreign exchange of different countries. So this is a decentralized market, I told you, to trade currencies. So whenever I say the decentralized market, that indicates it is not centrally located or is not an exchange. It's simply the OTC market, over the counter market. So the foreign exchange market is considered as the largest market in the world in terms of volume. So large number of transactions are happening every moment. Transactions are happening uh, to decide the uh, based on different currencies, and that determines the relative values of different currencies. Let's say a bank is buying dollars against rupees. So that is a kind of a transaction, and that determines the value of the currency. Whether the bank is buying rupees at which rate? What is the dollar rate? What is the rupee rate? That is an important thing happening in this market, determining the value of different currencies, and that assists international trade and investment in the uh, economies. So you can't do international transactions without having the foreign exchange market. So in that case, the foreign exchange market is facilitating international trade and international uh, activities, international investments, right? So it's a continuous market. Continuous in the sense, due to time differences, it could be long hours and very active market. So if you look at the structure of the foreign exchange market, here banks are acting as dealers, right? So these dealers are dealing with customers, different customers. So if you look at this dealer, he is having different customers. This dealer, he is having different customers. So customer trading is there, and they are also doing interbank trading, which means they have transactions across dealers, and there could be brokers also facilitating this transaction. Now in Sri Lanka, if I put this into context, in Sri Lanka, these customers are customers like, companies, let's say CPC, steel companies, vehicle importers, they are customers. They are buying foreign exchange or selling foreign exchange with the dealers. Who are these dealers? Simply the banks. So every bank is a commercial bank is a foreign exchange dealer. So they are doing dealing with the customers. Across them, they have deals. You can call it direct deals, right? And also, in most of the cases, brokers are facilitating these deals, because sometimes direct deals do not happen unless you have clear relationship or the clear need for a urgent particular transaction. Usually in the foreign exchange market, it happens through brokers. These brokers, you call them as authorized money brokers in Sri Lanka, AMBs, authorized money brokers. They are facilitating the transaction. Remember the role of a broker, role of a dealer. What is his role? Dealer is buying for his portfolio and buying and selling. He is making money out of buying and selling. So he buys foreign exchange, sells foreign exchange, and they make a profit. But broker, he cannot buy and sell foreign exchange. What he can do? He can facilitate these two people, seller of foreign exchange, buyer of foreign exchange. He can facilitate their meeting, the transaction. Through that, they earn a commission, right? They earn a commission. So the brokers are facilitating the transaction. So in this diagram, this shaded part is simply the interbank trading. This block is the customer trading, right? So I have taken this from the Deutsche Bundesbank, but that is applicable for our market as well. With that, we are moving to the discussion on foreign exchange rate. Right? Now, before I move to that part, my thinking is we should start this next week. Coming back to the past papers, I have two papers with me to find out some questions that could be, give some understanding about what we had discussed up to this point. Right? Now, there's one question in this paper, 2017 March paper on financial institutions, but that is also related to what we had up to now. Financial institutions provide financial intermediation and payment services to the public. Briefly explain the nature and importance of the following financial services to the general public. So in this question, there are four types given. For example, deposit taking. I hope you remember we discussed how they do deposit taking, what type of deposits and all that. Foreign exchange dealings. Remember what I discussed here? Foreign exchange dealing means they are, providing services to customers. So customers are asking for foreign exchange to sell. Customers are asking for foreign exchange to buy. So the dealer is basically helping to buy and sell foreign exchange through his portfolio, right? So he buys foreign exchange from the customers. He sells foreign exchange to the customers. That is simply the dealing. So out of dealing, he makes a profit. The difference between the bid price and the ask price, remember? Bid price for the foreign exchange, which means uh, the buying price. Ask price for the foreign exchange means the selling price. The difference is the profit. So I hope you remember and clear. Factoring, I hope you remember we discussed last week, long-term insurance, that is also covered. I just wanted to tell you there are questions related to what we have discussed while ago, foreign exchange dealings, for example, and some other questions we have discussed time to time. Probably you can look into that when you have some time. Let me check another paper whether we have a similar question related to the discussion what we had today. Now this question, this is again from 2017 September paper. Now this is the broad aspect. Look at this question. The financial system in Sri Lanka comprises a set of components which help the formation of capital, right? Briefly outline the role of each of the following components in the Sri Lankan financial system. What are these components? Financial institutions, then financial markets, financial infrastructure, financial regulators. Now, up to now, we have discussed two: financial institutions and the markets. Now, what is expected in this question? You don't need to go into the, sub markets or sub institutions in this question. What you have to say, what is the key role played by this market? Now, remember in our first few slides, I already always discussed the role of financial institutions, the role of financial market, why it is needed for the broader economy. So you have to basically get inputs from the slides and our discussion, and you have to think on your own why it is important for the Sri Lankan context. What is the purpose of having financial institutions? Why do we need to have financial markets? How they active, how active they are in the market, in the Sri Lankan market. Likewise, you have to have some understanding. Now, I hope this question is really interest for you because I discussed this intensively, very detailed. Remember, listen to the question. Financial institutions provide various services to their customers. Their services may range from traditional fund-based services to modern fee-based services. Remember, I discussed this in detail: fund-based activities and fee-based activities of banks or financial institutions. So the first question is, briefly explain the nature of fund-based services, giving appropriate service examples. I hope you remember, fund-based is simply on-balance sheet activities. Remember, they earn a profit, earn a return in terms of interest, right? So these are interest-based activities. Briefly explain fee-based activities, giving appropriate examples. I hope you remember, we discussed off-balance sheet activities, which are not reported in the balance sheet. In that sense, they are not based on interest. They are simply generating fees and charges. Briefly explain that how the banks move from fund-based services to fee-based services in the modern world. And there again, I told you, banks are facilitating intermediary services through their balance sheet activities. And apart from that, banks are engaged in services to generate additional income. So that's how banks are moving from non-interest income to non-interest income. Remember, banks are trying to generate non-interest income through off-balance sheet activities. For example, by way of providing innovative banking practices. For example, they want to diversify their income. They want to attract more customers. They want to specialize in certain areas. There are certain banks people would like to access. For example, for opening an LC, some people would think, okay, this bank would be the ideal place. So in that way, the banks are trying to provide customized service, especially in terms of providing services to their customers. And the competition between foreign banks, local banks, right? That is also one aspect why the banks are moving from fund-based activities to fee-based activities. Because fund-based activities, the profit margins over the time through competition has narrowed, right? So the banks are thinking of having more diversified profit avenues. That's why banks are moving into these off-balance sheet or fee-based activities. And the fourth part is major risk of these fee-based financial services. We'll outline the major risks. Now, what are the major risks? What are the major risks? Basically, when you have more balance sheet activities, your interest income is simply reduced, right? So you are not based more on interest dependent traditional banking. So you are moving to new areas. Now, these new areas, probably not only banks are providing, some other services are also providing. For example, let's say you are providing derivative services as a bank. There are other derivative players also. There are hedge funds. There are investment type of banks. There are insurance companies. There are foreign exchange dealers, right? Foreign exchange money exchanges. They are also providing similar services to these off balance sheet activities. So that could lead to some competition, and you might incur some, stress as a bank if you are moving into more fee-based activities. And also another factor to increase the cost, uh, to increase the risk, is considered as the operational cost, right? So when you are increasing your off-balance sheet activities, maybe you are increasing your fixed cost, because off-balance sheet activities would involve certain costs. So you might be increasing the cost, and compared to traditional activities, you might be increasing the cost of your fee-based activities. And sometimes there could be, some risk also. For example, these activities are like, commitments, temporary arrangements. Sometimes the transaction may not realize, right? You might not incur a loss, but still you carry these, to some period, for some period. So you might be having some cost involved, even though you might not make any loss out of these transactions. So that is also one aspect. There are some risks in relation to these off balance sheet or fee based activities, right? So likewise, in several papers, you have questions related to the matters we have covered up to now, especially financial markets and uh, financial institutions. So I really recommend you look at these things in detail. Now, from next week, we spend little bit of time discussing the exchange rate, and we do some calculations also. I hope, I think I told you last week also, to come up with a paper and a calculator. Still, that advice is valid. Next week, we do some calculations in terms of exchange rate, and you might have to have some paper and a calculator. And very quickly, I'll be looking at the Sri Lankan market and some examples, exam questions, and then we'll conclude the discussion on financial market products part one. In part two, I'm discussing the features of different products, like what is a feature of a deposit, what is a feature of a loan, what is a feature of a bond, what is a feature of a derivative. That's also a lengthy discussion. So I plan to finish this part next week and start that very soon, right? So let's stop at this point, and I'll see you next week at the same time. And please bring your paper and the calculator, because we do some calculation next week. Okay, so let's stop at this point. Have a good weekend, and see you next week. Thank you.